Thank you for being on stage. Thank you for being here tonight with us today. But please tell us what happened to the prediction marketplaces and how this is better than what was before. Welcome. Round of applause. Thank you so much.
Hi, guys. Thank you for coming here. My name is Rossen, and for a year and about 4 months, I've been working day and night on the least hyped area of crypto and blockchain, which is prediction markets. Thank you for the great intro. So I formed a very strong opinion about the past, the present, and future of prediction markets, and this is what today's talk is about. So let me just first start with, well, prediction markets are dead. As you mentioned, this was the first project that Gnosis worked on, and that was in 2016, 2017, and after that, nada, wrecked. We'll go through a little bit of history, but I'm not the first person to basically proclaim prediction markets dead. Critical thinker, popular crypto personality Hasu of the Uncommon Core podcast actually proclaimed prediction markets to be doomed in 2020 already. And the article was called The Problem with Prediction Markets. So let's start with, does anybody here disagree that prediction markets are dead?
We'll have a separate conversation with you, sir, later.
Very good. Well, where I come from, they say, in argument, the truth is born, so maybe we can speak after. Can I ask, is that my clicker? Beautiful. So, but you look like a smart guy, maybe I run away, we'll see. So let's establish the essence of the topic. Prediction markets, what are they? Prediction markets, also known as betting markets, information markets, etc., etc. These are open markets where specific outcomes can be predicted using financial incentives. And another term that I will use today is specialized prediction markets. These are, again, prediction markets, but these are optimized to serve a specific area of outcomes and events. This can be sports or politics or any other specific area, let's say. So looking at a brief history of modern-day prediction markets. 1988, University of Iowa does an experiment around the US election. Then 1990, at Project Xanadu, Robin Hanson, who is now called the father of prediction markets, does the first corporate prediction market for the employees of the project, and they were basically betting on the cold fusion controversy. Then, in the year of 2000, something that you might not expect to see here, but is very relevant, Betfair becomes one of the first online betting operators in the world, and they're the first betting exchange. Now, betting exchange might be unfamiliar to many of you here, but a betting exchange is actually a custodial prediction market focused on sports. 2008, the term futarchy becomes New York Times Magazine buzzword of the year. Futarchy is a new form of government which is proposed by Robin Hanson, in which prediction markets are used to determine what is the best decision for the public. 2014, things are getting interested. Decentralized prediction markets are one of the few core primitives that are very, very, very broadly covered in the Ethereum white paper. 2015 and 2016, Augur, which is a prediction market platform, becomes the first ICO on Ethereum. Gnosis, which many of you here would know about, becomes the first project that is backed by now Ethereum Kingmaker consensus. Years pass, however, and there's little traction. Still, Polymarket comes to the scene, 2019. They focus on politics. 2021, Augur still delivers another project, but still, basically no traction, Augur Turbo. And 2022, a project that I'm sure many people here would not be aware of, as I was not, like for a long time, even though I was working already on this. They claim they're the largest blockchain prediction market, SX. We'll see what the state is now. So that's how things look. Augur are essentially defunct. Gnosis have moved on for many, many, many years to other projects, and they found amazing success, as all of us know. But prediction markets are not one of these. Futarchy is nowhere to be seen. It's not used. Polymarket, which is arguably one of the, or probably the biggest prediction market and most successful prediction market in the world today, has normally under 20 markets with more than $10,000 in liquidity. SX, as we just mentioned, the self-proclaimed biggest, have under 400 monthly active users. And Betfair the prediction market approach to a online betting service, although being the biggest such service in the world, actually represents well under 1% of the betting volumes and users globally. That's a funny case because it's played out for many, many years, since the year of 2000, and the online betting market has been won completely by a different approach, not the prediction market approach. The approach is so-called bookmaker or sportsbook. There, the house is playing versus the players. It is not a platform where the players are playing versus other players. And the experience that the house is providing is much richer, better, bigger, and that's been the successful case for online betting, not the prediction market approach. So what are the problems with prediction markets? First, if we're speaking about general prediction markets, so imagine people betting on basically any topic out there, there's no natural liquidity. People have not shown any inclination to bet really on events apart from sports, finance, and politics mostly. And that seems unlikely to change. Beyond the liquidity, however, if we speak about more specialized cases, right, for example, prediction markets for sports or finance, you would see that the user experience is a big problem. Prediction markets do not provide, in their current state, an experience that is rich enough in order to capture the attention and basically the usership of people. The competition there is very strong and entrenched, and it is really optimized to offer the best user experiences. So is there light at the end of the tunnel? Yes and no. Actually, we created a slide like this at the end of 2021, so a couple of months after we started working on our project, Azuro. And there was 20+ new projects that were working on prediction markets, most of them on specialized prediction markets, either for sports or for finance. So there was something there. There was a lot of projects, some of them well-funded, that were thinking, okay, well, prediction markets are not so dead after all, or maybe something can happen here. But there was a problem. All of the projects, apart from ours, were working on peer-to-peer prediction markets. Markets where you basically have market makers versus players. Peer-to-peer exchanges. Why is that a problem? We argue that the problem with prediction markets, and particularly specialized prediction markets that need to go after areas where there's a lot of liquidity, but also there needs to be a lot of events and a lot of options for people to interact with these betting markets, is the peer-to-peer design. In the peer-to-peer design, you have a market maker on one side, and you have the players or bettors or etc., the users that are interacting with these markets on the other side. The market maker is expected to provide their own liquidity, so risk their own money, to determine the odds, the initial odds of the market, so they need to price these markets, understand these markets, and they need to manually create the markets. So all of these things together basically create a very heavy burden for market makers, which, on the other hand side, is matched with a very little reward. As a result, there's almost no markets and events. Market makers do not do this, and especially in areas, if, for example, we're speaking about sports, as we will speak here more, the necessity is for thousands of betting markets at any point in time. There's so many sports, leagues, events, teams, etc. It's a lot. And when there's basically none, then nobody's interacting with these markets. The other part of the problem with the peer-to-peer design is the user experience. With the peer-to-peer design of prediction markets, you have one pool that is correspondent to one outcome in a betting market. So let's say this thing is going to happen, that's one pool. This thing is not going to happen, then another thing is going to happen, etc. Pool, separate pool. You have outcome-specific liquidity. And with that approach, you have many problems, which are connected to the user proposition and the user experience that people can get. I'll give you one example from the sports betting world. The most popular type of bet in sports is called an accumulator, or a parlay in the US. This is when one person takes bets in multiple betting markets, and if they guess everything right, the outsized return of the payout, you know, like, is what makes people crazy about these types of bets. But with the peer-to-peer design, that's impossible, or nearly impossible. With the peer-to-peer design, this is one example of the problems, but there's many other examples which are basically in the same direction. It is inhibitive of creating a rich overlay of experiences on top of the betting markets. And this leads to bad user proposition and bad user experience overall. So if peer-to-peer is the problem, then can anybody guess what the solution might be?
Centralize everything.
That's already been done. Like that's already done. Like if we want to do something new. Okay, the solution is peer-to-pool. It's actually very similar and inspired by what happened in DeFi in early 2020. So you had, some of you maybe remember, ETHLend, which is now Aave, was ETHLend, and it was peer-to-peer lending protocol, but nobody really cared about ETHLend. There was decentralized order book exchanges, but then the AMM came, and we got DeFi and Uniswap and so forth. We argue that actually the same thing is going to happen to prediction markets, and particularly prediction markets that are specializing in tough areas, like sports or finance or politics. The idea goes as follows. The market maker's role is actually broken down into 3 separate roles. Liquidity providers provide money to a common liquidity pool. They do not need to understand betting markets. They do not need to care about betting markets. They don't need to create betting markets. Then, on the other hand side, we have data providers. Data providers only price the markets. They specialize in pricing. So these are more sophisticated entities that only do pricing of markets. Then oracles are taking that information about the priced markets and events, and they're importing this on-chain. After the interaction between the oracles and the data providers, you have a feed with priced betting markets. These can be limitless. Scale here is of no problem. Then these priced betting markets meet chunks of the liquidity from the common liquidity pool. The common liquidity pool is used to seed initial liquidity into the priced betting markets, and now at the end of this whole thing, you have priced and liquid betting markets from the outset. Markets that people can actually come and interact with directly and take positions in. Now, so far so good, but there was a problem. The problem is that liquidity pool designs, as of today, could not actually meet the necessity of the specialized prediction market liquidity pool that should pool liquidity for prediction markets. A classic liquidity pool design looks something like this. So maybe there's 2 assets, like if it is a pair, trading pair, or maybe there's more assets. But the idea is that people can add liquidity and then withdraw liquidity. And at any point in time, it is clear what amount of each asset there is in the pool. This, however, is not the case when it comes to the prediction markets liquidity pool that we needed. Why? Imagine that this is the money that goes into the pool is just one asset. So maybe it's DAI, maybe it's USDT, maybe it's Ethereum. Okay? So it's one currency. And then from there, this needs to go into different outcomes, which are part of different betting markets. And these betting markets are connected to real-world events. That means that the liquidity from the pool goes into markets, some of which are resolved, and everything is clear, and others are not yet resolved because the events have not really happened in the world yet. And the markets which are not resolved, it is unclear how much money they will return to the pool. Because with this design, some markets are going to return more money, therefore making a profit for the pool, and other markets are going to return less money, therefore losing money for the pool. So allowing liquidity providers to add liquidity and withdraw liquidity with that uncertainty was a big problem. The lame solution would be to track the liquidity, the money that each liquidity provider provides to the pool, and then where this goes, with timestamps, amounts, flags, etc., so that you can actually stop liquidity providers from cheating, so that it's clear where the liquidity has gone. But as you can guess, with, again, flags, amounts, and timestamps, that solution is really, sorry about that, is really lame. Because with that approach, the size of the data that is required is way bigger than the block size allows. It really is not suitable for a blockchain approach. So that led us, Azuro, to create a new custom liquidity pool design for specialized prediction markets. We called it the liquidity tree. It's called a liquidity tree because it utilizes a data structure which is popular in computer science, which is called the segment tree. The segment 3 allows for orders of magnitude of efficiency increase in terms of the amount of data that is needed in order for the liquidity pool to operate efficiently and not allow liquidity providers to cheat, well, the other participants in the pool. Now, I cannot tell you anything more about that because I do not understand more about it. I'm not a technical person. So if you want to ask me about this one, I will not be able to say much more. Bottom line is, it allows for the prediction markets liquidity pool to operate and to allocate liquidity from the different LPs to the different markets. Zooming out a little bit, the liquidity pool is here. It allows that magical interaction between liquidity providers, oracles, and data providers. This is at the protocol level. This creates a feed with priced and liquid betting markets. Then, at the application level, you have front ends. Essentially, the marketing and the user experience is outsourced to front ends, which can specialize in different markets or different geographies or different user experiences. And then you have the players or bettors that interact with the environments that the front ends are creating for them. As a result, you basically get a decentralized ecosystem for specialized prediction markets. Azuro is actually live on mainnet Gnosis chain for a couple of months, nearly 3 months, I think now, since mid-June. There's more than 80,000 transactions, 2,000 users, more than $500,000 in bets, and nearly 5% of the Gnosis chain active users recently. This is with a very raw beta proposition that only has sports markets and only markets basically for football and for Dota 2 and CSGO. So where does this lead us? The current state. We already see that the same slide that I showed a little bit earlier, we already see 1, 2, 3, 4, 5, 6, 7 of the other projects that were doing peer-to-peer prediction markets for sports and finance have already started speaking about peer-to-pool. They're moving over. So to end on a positive note, there is meaningful innovation happening in the space of specialized prediction markets, albeit a little bit rebranded to decentralized betting, that I'm extremely excited to be a part of and to be part of the project that is leading the charge in that regard. If you want to follow or participate or maybe even build on top of Azuro, then follow the link which has some links underneath that are connected to the talk today. Long live specialized prediction markets. Thank you.
So, very cool. Any questions?
Yeah, thanks for the talk. Very interesting. So, if I understood you right, instead of betting against other players, I'm betting against the liquidity pool, right?
Yes, although it's a little bit more complicated than that. The initial markets are created by taking chunks from the common liquidity pool. So when you have a market and there's some liquidity behind, basically this is going to happen, some liquidity behind this is not going to happen, etc., yeah, this liquidity initially is provided by the common liquidity pool. But then, once people start interacting with these markets, then the liquidity grows and people can bet on any of the outcomes, and therefore the liquidity behind that particular market starts growing as well. So initially people bet against the pool, but then after that against each other as well.
Okay. So if I take part in the pool, I get a reward or something? Or
yes, the economics are pretty cool because it's a cash positive business or protocol. The idea is that in the prices of the markets or the odds of the markets, there is a margin or a spread. Okay, this is the difference between the probability of the event happening and the actual price that people can take when they bet, right? Out of that difference, there is profit for the pool over time, and actually the pool is profitable just after 1,600 events. So, which is pretty, it's not much when we're speaking about sports betting, which really, there is a lot of events. The liquidity pool profit goes to the liquidity providers, the front-end operators, and to the DAO. And then parts of the fees are going as well to the data providers and the oracles.
Okay, so because in game theory perspective, like this betting market is a zero-sum game, basically. So somebody's paying for the profits
Correct.
of the
These
other
are the
side?
people. These are the players. These are the
Yeah.
people who interact with the betting markets.
So how do you keep the players motivated? Like when they lost once, are they going to stay within the game or?
So
like
there,
how-
yeah, so there is. I think I'll answer this one like that. There is more than 2 billion people in the world who have placed bets on sporting events. 99.9% of these people are losing money over time. Like if they do it but they keep doing it. Okay. So the demand is there. That's without question. And actually, betting in a decentralized way brings a lot of positives versus centralized betting, which is huge already in terms of the transparency and the non-custodial nature. People here bet directly with a smart contract, and everything is visible. They cannot get a declined payout. Nobody can ask them about something and say, well, I'm not going to pay you your money, etc.
Sir,
Thanks.
I forgot to mention that every question is like 10 DAI, so please submit your payment later. Who else wants to ask?
So, historically, what went wrong with the previous more generic prediction markets, and how does that lead to these more specialized prediction markets? Like, what were the learnings, or what were the backslashes from regulation, and why there was so much censorship, and how do we come to this day then?
Well, I think from my perspective, there's objective reasons for prediction markets not really taking too much traction in the past. And some of the objective reasons were maybe blockchains were really not so prepared. Like when Ethereum was congested and it was slow and expensive, that was not a great, like environment to actually have a high transaction frequency, like markets to be part of. Then I think also early teams had great understanding of the technical aspects, but not so much understanding of specialization. Like for example, if we're speaking about sports markets or finance markets and so forth. And many projects also early days were not built with the idea of regulation. So they were not positioned and designed in a way that could withstand over the long term. But above all, we actually believe that there was 2 problems. One was just general prediction markets, like about anything. There's not much liquidity, really. People do not participate in markets unless they really care, and people care about sports and politics and like really big social topics, right? But beyond that, they don't really provide liquidity to these markets, and that was a big problem. And then now I think the reality is that, yeah, many projects realize that they need to specialize for a particular area, which has natural liquidity, but the way to do it, we argue, is not with a peer-to-peer design.
Thank you, Rossen. I think this was the last question, actually, because we are ready for our next speaker. And thank you so much. A round of applause for Rossen. So when are we going to be able to bet?
You can already.
Already can. Okay,
Yes.
I'm going to go and submit my stake later.